Good morning, everyone. Good morning, everyone. Welcome to the 2016 Economic Outlook Breakfast. My name is Shannon Full. For those of you that I haven't had the opportunity to meet, I have the pleasure of being the president and CEO of the Fox Cities Chamber of Commerce. I just want to make sure I don't break it. Thanks, Manny. We're really happy to see a full room here today. We've done this event now for 22 years, the Economic Outlook Breakfast, and we're really very fortunate to have the speakers that we have for you today. I want to give first of all, some thank yous. As you all know, sponsorship of this event, as well as the rest of our events, is really critical for us to continue to have the resources to put together great programming like this. And so I really want to take the time to recognize our sponsors. Our presenting sponsor is Chase, JP Morgan Chase. Bruce, thank you for not only your financial investment here, but Bruce has been our treasurer for the Chamber for many years and now has moved into the vice chairman role. And so to your leadership, I'm really grateful for that. Thank you very much, Bruce. So our presenting sponsor is Chase. We have three contributing sponsors, Coldwell Banker, the Real Estate Group, Fox Communities Credit Union, and Wipfli. All three of those also are investors in our Fox Cities Regional Partnership, as well as Chase. So the Regional Partnership is really the sub-brand that puts this event on. But we also, the Chamber as a whole, has a very simple mission, and it's really to promote growth and prosperity throughout the region. And we're really dedicated to that mission. You'll see that over the course of the past few years, there's been a lot of expansion as it relates to investment in our organization, as well as different events. We're really focused on making sure that we're solution-based strategies, trying to help you in every way we can grow business here in the region. Many of you are from the financial world, and so I wanted to put out a couple of tips for you, because we can also be of great service to your clients as well. We really focus on three major areas, and that's investing in people, strengthening business, and inspiring the community. And as it relates to how we can help your clients, we've got a couple of things that I wanted to feature. One, tremendous talent services. You probably have heard recently about our Talent Upload program. Manny may go into that a little bit, but that's a program that we're really focusing on attracting high-quality talent to this region. We also have tremendous research and data capabilities, and because this is a data type event, this is kind of a data type of a crowd, we wanted to highlight the fact that we've invested significantly in the ability to have the software that slices and dices data and allows for us to do comparative analysis against other communities. We've had this, those of you that were at the report to the community, we recently worked with the airport to secure another direct service based upon the data and the information we were able to present. So if you've got clients or you have needs, we do that free of charge. It's really a service that we provide. So if there's any opportunity or need for that, we would welcome that opportunity to work with you. My piece of the program is really short, which is what I really love about this event. I now get to introduce Manny Vasquez as our Vice President of Economic Development. We're extremely fortunate to have Manny have joined us 2 years ago, almost 2 years. And he joined us really first in the form of doing our existing industry work, so going out and doing our 100+ retention calls to our primary employers, finding out what are their challenges, what are their needs, and how can we put our services to help them. He recently assumed the role of the Vice President of Economic Development, and his background is really working with 2 different congressmen and has just a phenomenal personality for this job. We're very, very lucky to have him. So please help me welcome Manny Vasquez.
Good morning. Thank you, Shannon, for that kind introduction and for your leadership. Thanks again for being here with us today. 400 and some of our closest friends. We appreciate you taking the time to learn more about the regional economy as well as to hear from our renowned speaker in a few minutes. As Shannon mentioned, I have the great pleasure of leading a tremendous team and organization in the Fox Cities Regional Partnership. And speaking of talented team, I wanted to thank Beth Britzel for her help preparing the presentation that we'll be talking about this morning and also conducting the actual survey. So thanks, Beth. So what is the Fox Cities Regional Partnership all about? Our mission is to enhance the quality of life for all of us in this room, for local residents. And how do we do this? We do this by helping to attract, retain, and expand primary jobs. What's a primary job? A primary employer is a company that derives most of its revenue, makes most of its money, selling a product or a service outside of the Fox Cities. Now, primary employers are not dependent on size, although most of our area's largest employers are primary employers. But you can be a one-person primary employer if you write code or develop software for the Milwaukee and Madison markets, for example. We're working with someone like that right now. You are a primary employer. So why this importance given to primary employers? Well, primary employers have the responsibility and the work to generate new dollars that get put into our local economy, that come home and support most of us in this room, retail, service, and professional sector specifically. So this is why we are very concerned and allocating our time and energy and resources to making sure that we nurture and foster primary job creation here in the Fox Cities. Now, when we were created by the Chamber Board of Directors about 4 years ago, we came up with this goal of helping to create, and helping is the right word here, we don't create anything, helping to create 1,200 new jobs, primary jobs in the Fox Cities. So if we're successful with this goal, and by the way, that was by 2017, year 2017. If we're successful creating this goal, that means millions of dollars in new annual payroll, millions of dollars in new property taxes that help support our top-notch municipal services, and an overall economic impact that we can all rally behind. So how are we doing with this ambitious goal? Well, to date, we have assisted 13 companies to create jobs. These are primary employers, and these involve 9 expansions and 4 attractions. So our team has helped these companies pull the trigger, either by choosing this site, this community, as a place to do business, or choosing to expand a current operation here in the Fox Cities. And this is taking place throughout our service area, which is Outagamie, Calumet, and northern Winnebago County. We have a pretty nice split between those 2.5 counties in terms of where the projects are taking place. Now again, we don't take credit for creating any of these jobs. The private sector creates the jobs. We are the point guards. I'm a basketball fan, so I'll use a basketball analogy. We're the point guards, and we can't be successful with without a successful team, right? We try to coordinate the plays and give the ball to our big players, our all-stars, our employers. They're the ones who create jobs. They're the ones who score points on behalf of our region. Now, as you can see behind me, and this is true in many communities, not just the Fox Cities, but most of our job growth will come from existing companies expanding versus the new shiny buildings coming into our region, although we do work on that as well. And because of that, we have a fully staffed business retention and expansion program, and Rob Peterson is here who manages that program. The program seeks to address the needs and challenges and the opportunities of primary employers in the area. So talking about not just what keeps them up at night and what's causing headaches, but also, hey, I've got an expansion opportunity that we need your assistance with. And again, these are some of the results that you see on the screen. So we're excited. We have some good expansion projects in our pipeline. So hopefully we can continue to remain on track in meeting this goal. Now, again, talking about primary employers and existing primary employers or existing industry, it's precisely our existing employers who keep telling us year after year that talent, or lack thereof, is the biggest obstacle standing in the way of growth. And we all know this, right? We've heard about the skills gap, the talent crunch, and other terms. And it's an issue that we need to be working on, and we'll look at some survey results in a few minutes here and see how our region is handling this challenge. But the companies whose logos you see on the screen identified a very specific need, and you heard Shannon bring this up. This is our Talent Upload program. The companies whose logos you see told us, I need entry-level IT, computer science, and engineering talent yesterday. I need it now. We were able to identify specific numbers of job opportunities. And as a result, our talented team with the leadership from Shannon helped put together a program called Talent Upload. So Talent Upload is a talent attraction program, an aggressive and innovative talent attraction program, where we host large groups of college students in the Fox Cities for a career exploration and community familiarization tour. It's a long name, but essentially it means come to the Fox Cities, talk to our HR folks from these companies and CEOs, et cetera, and experience life as a young professional in the Fox Cities. Because for millennials, and I'm one of them, so I know this, for young people, it's very important to know where you're going to live as much as, sometimes even more, than where you're going to work. So we thought that by showing the entire package and showing them the job, the facility tour, and also the community, we were going to create a pretty impactful program. Now, we're a solution-based organization, and Talent Upload is no exception. We like outcomes, we like data, we like results, right? So I'm happy to report that Talent Upload has led to some pretty exceptional results. Now, you'll see on the screen the number of students that we've hosted from universities across the Midwest. And these results are based on 2 Talent Upload sessions that we conducted in the year 2015, spring and fall of 15. The companies whose logos you saw were behind this effort and participated. And we've heard so far of about 14 placements. Now, we targeted freshmen to grad students. So the placements involve internships and also full-time employment. So we're excited that the results keep on coming. Now, we were also excited and humbled to win an international award for this thing. So we went to an economic development conference, and over 500 entries were submitted for the special event of the year. And the Fox Cities brought home the trophy, which is a good opportunity for our organization. It gives us some street cred in the economic development world, but it's really a testament to the employers that participated in this program, and it's a good marketing opportunity for the region. So that was exciting. So now let's move into some survey results. I know you're excited to see that. So as many of you know, we conduct an annual survey, and Shannon mentioned this is the Chamber's 22nd consecutive year doing this. So that gives us a pretty neat opportunity to look back and see how far we've come. So the point of the survey is to see what the previous year was like for businesses in the Fox Cities, and also to hear their projections as to what they see coming for the new year, 2016. Now, the economy is like the weather, right? It changes constantly. In Wisconsin, we know a thing or two about that. We have the 4 seasons in this state, and usually the seasons that we dislike the most tend to linger the longest, right? The economy, in a way, is a little bit like that. Now, we remember what the economy was like, what the economic climate was like in 2009, 2008, and 2010. And after a sluggish first couple of years of quote-unquote recovery, it wasn't until the end of 2014 that we began to see the momentum of the national economy finally start to go in the right direction. And Dr. Chan will talk more about this, I'm sure. And as a region, we've weathered the storm pretty well. Our industry is diverse. Our industry is resilient. We're tough in the Fox Cities, and we got to be proud of that. But we've got a lot of work to do yet. The storm is not officially gone, and there's another storm brewing somewhere out there, and we all know that. So we surveyed 202 businesses as part of this annual survey. Now, we make an effort every year to diversify the results and the companies participating in the survey to give you and our team the ability to look at a pretty comprehensive list and results and a good representation of our region. So on this slide, and you can follow the presentation used in your booklets, by the way. A lot of the similar slides that I'll be talking about are in your booklets. So you can see that we have a pretty good diverse group of respondents. And the main sectors that we see participation from are manufacturing, service, so not only hospitality and food industry, but also professional, technical, administrative services, healthcare, among others, trade, wholesale and retail, finance, insurance, and real estate, that's what that FIRE stands for, and other, which is construction, government, transportation, education, among others. So combined, these employers employ over 35,000 Fox Cities residents. So again, it's a pretty good chunk of our community. So let's dig a little deeper and check out some results. This got us pretty excited here, this particular question. So 53% of businesses who responded to this survey, again from the 202, told us that employment compared to the previous year was ahead. This is the largest percentage that we've seen in this particular question since the year 2000, folks. So it's taken us 16 years to get to this particular level. So this is exciting. Now these are actuals, not projections. So these are folks saying, yes, my employment numbers were ahead of the previous years. Just to put things into perspective, how long we've come, this number, 53%, was at 22% during the recession. So we're trending in the right direction. Excuse me. Let's look at employment numbers. 53% of companies surveyed told us that employment was ahead as well. Sorry, I think I skipped a few. Let me go back. Profits, that's where I was. 63% of businesses surveyed told us that this is the best year in terms of gross profits since the year 2006. Now, what caught our eye in this particular question is that 81% of trade, again, wholesale and retail, indicated, and again, 81% indicated the profits were ahead of the previous year. So good job to everyone for shopping a whole lot in the previous year. Something I wanted to make a note of on this particular chart. Employment, again, is up 53%, saying that employment is ahead of the previous year. Again, the largest percentage since the year 2000. The other side of the coin, and this is something to keep in mind as a red flag, right? It's something to be concerned about, is that the labor market continues to get tighter. The more and more that your businesses continue to hire and increase their workforce levels, the more and more competitive the job market becomes. So we'll talk about workforce some more in a little bit, but just wanted to highlight this fact. Now, this is another exciting metric for us. 27% of businesses surveyed told us that they anticipate a capital expansion or capital investment in this new year, in 2016. 27%. Now, you can see that it's trending in the right direction. Right? This is a 7-point increase from last year's survey. And now, what's encouraging to us at the Regional Partnership is that almost 40% of these folks, of the surveyed manufacturers, which is about 20 companies, responded yes to this question. So why is that important? Manufacturing is the bread and butter of our community. 22% of our workforce is engaged in manufacturing. So manufacturing is well and alive and kicking butt in the Fox Cities. Now, we compare that to the national level, that's 9%. So we have 2.5 the manufacturing participation levels that we do at the national level. Why is that important? Manufacturing pays a wage that's 33% higher than the average wage across the economy. The average wage in manufacturing in the Fox City specifically is $57,000 and change. And that's a good family supporting job. And that's definitely a lot more than a lot of us were making out of college. So this brings up the reminder that as a community, we need to embrace that. We market our region when we try to attract new businesses to the area. We market it as made better here. That's our tagline, that's our brand. We make stuff here, we make it really well. Manufacturing is an attractive career path, right? So we need to continue to work together as a community to paint it as such. And I know that we're working very closely with our higher ed folks in K through 12 in ways to do that. Now, something that concerned us, and this is a national picture, but there's a report by Deloitte and the Manufacturing Institute that indicates that the gap in workforce as it relates to manufacturing is getting worse. The report says that nearly 3.5 million manufacturing jobs, 3.5 million, will be created over the next 10 years. 2 million of those 3.5 million will go unfilled. So this is a huge challenge, but also a great opportunity for our region and for our state. We're a manufacturing region and a manufacturing state. So something to keep in mind there. We asked our businesses to rate the national economy at the present time, the economic vitality, the national. 43% of our businesses rated it as excellent or good. Now, the number is virtually the same as last year's survey, so there's no dramatic change there. And as you can see, on the excellent and good category, the trend line is going in the right direction, and we've come a long way in the past couple of years. Now, on to the local economic vitality. 62% of the businesses responded that the local economic vitality at the present time is excellent or good. And again, a nice steady trend line that we see here. This number, 62%, is the highest rating in the business survey, which started in '95, since the year 2007. So again, a very good indication that our local economy is going in the right direction. Now, the point in showing you this slide is to show that the green line, the local economy, and the blue line, the national economy, tend to parallel themselves across the board. Now, the local economy will usually, and we can see on the slide, rank higher than the national economy. I think this has something to do with the ability to have more control, in a way, of the local economy versus what goes on at the national level, which Dr. Chan will talk about. So workforce. This is the storm that's brewing, folks. Last year, we took a pause to talk a little bit about this issue, and we'll do it again because the issue isn't going away. It's only getting worse. The traditional economic development model is being challenged. This is a really exciting and concerning time to be in economic development because real estate availability, tax incentives, transportation, infrastructure, proximity to market, all of these standard traditional factors continue to be very important. But talent, the availability of qualified workers, is at the top of the list now. So as a community and as an organization, we are allocating our time and our resources to make sure that we're on the winning side of this rat race for talent across the country, especially as it relates to manufacturing. We just heard some statistics about that. So 78 million baby boomers will be retiring in the next 50 years, right? We've heard that number. And that book is really scary, by the way. If you ever want to read some scary stats about the boomers bailing and leaving the workforce, pick up a copy. It's rather scary. But again, it presents us with an opportunity. Our national birth rates have dropped by 50% in the last 50 years. Onshoring is back. More companies are making stuff and producing here. And again, we see that evidenced by employers hiring more people and expanding, right? So this is just a recipe for the labor market becoming even tighter. The labor market shortage is going to be one that we've never seen before. So again, things look pretty good for the Fox Cities in the year 2016. Things are mild and sunny, and that's the forecast, but this is the storm that is brewing, and we need to continue to pay attention to that. So now let's dig a little bit deeper into the responses on this year's survey as it relates to workforce. So we saw that the employment numbers for the previous year, so this would be for 2014, were up. compared to the previous year. Now, this is the availability of qualified workers across all sectors. We asked the question to our businesses, how would you rate the availability of qualified workers in the area? 42% of them said excellent or good, which is the same as last year's survey. So that's a big sigh of relief. Things aren't changing a whole lot there. Doesn't sound all that alarming. But let's do a fun exercise here and look back 16 years. Again, availability of qualified workers across all sectors. These are the businesses, or these are the responses that included excellent or good as their ranking. Now look at the difference here. And it's a roller coaster ride, but we're going down a hill, right? The economy is improving. More people are working, so the labor market is tighter. Again, something we need to keep an eye on. This was a fun one. So this was a correlation that we thought we wanted to highlight. So this slide tells the story that there's a relationship between how businesses rank the local and national economies, which again are the blue and green lines, to how they rank the availability of qualified workers, which is the orange line. So it's interesting that when the economy is healthy and more people are working, the availability of workers is less, right? The ranking goes down. So there's an opposite relationship there. So again, great news. The economy is improving. Things are looking very good for the region, but this is what we need to keep an eye on, and something that we need to be proactive and aggressive on is this workforce issue. So we asked our businesses as well, compare the Fox cities as a place to do business to other cities of a similar size across the country. 67% of them ranked the Fox cities as better or much better as a place to do business. And this is an improvement from last year's survey, which was at 64%, so 3% improvement. However, you can see here on my left, it's going down, right? Now, this is a concern to us because there are 5,000, give or take a few, economic development organizations like the Fox Cities Regional Partnership across the country, 5,000. And they are very aggressive. In fact, our local employers tell us that they get phone calls and postcards from other communities that are trying to recruit their businesses to their turf. So the red flag is that as aggressive as those communities are, they may become an attractive option, an alternative, if the Fox Cities as a place to do business continues to decline. Now, again, not a dramatic change. I'm not trying to scare anyone here, but it's another metric that we have to keep in mind. And again, we need to be proactive. We need to be boots on the ground, meeting with our primary employers and trying to identify what's keeping them up at night. What can we do as an organization to help them continue to grow and address the issues that they're facing? And we do. Quality of life, right? How many of us here are proud of our quality of life in the Fox Cities? Yeah. Now, we asked the businesses to compare the Fox Cities, again, to other US cities of a similar size in terms of living here, quality of life. Now, last year's percentage in the much better or better category, this is last year, again, not this year, was the lowest it's ever been since the survey began in 1995, folks. Now, the good news is that this year, the percentage is up. But again, this is another very important metric. We're all proud of our quality of life. And if our quality of life begins to get away from us a little bit, then other communities become even more attractive for our local businesses. So Fox Cities as a place to do business and Fox Cities as a place to live are important, and we should keep an eye on that. Now, I should mention that this is not a statistically valid survey. However, this shows that it's pretty darn close in terms of what businesses forecast and what their actuals were for the same year. And across the board, and you look at this slide, employment, sales, and profits, what they projected, which is the blue bars, and what the actuals were for the same year, the green bars, are pretty darn close, especially the sales. I mean, spot on. So again, this is not a statistically valid survey, but the integrity of the survey appears to be good based on this metric. So we looked at actuals. All of the information that we've been reviewing is how 2015 actually was for the businesses surveyed. We also want to know how they see 2016, and we asked for their projections as well. So now let's move into that. So sales. 70% of businesses reported that sales, they think, will increase in 2016. That's a pretty good number. That's the highest number since the year 2006. So again, more good news. Profits. 68% of companies surveyed said that the profits will hopefully increase in 2016, this year, the highest since 2008. Employment this year, 52% of local businesses surveyed said that their local employment will also increase in 2016. This is the highest since 2005. So this is a nice trajectory over the past few years, and when we look back 10 years, we see a really nice steady increase as well. So to wrap up, we also ask our businesses to give us an idea of how they see the local economy by the end of 2016. Again, a projection. So 62% of local employers said that the economy will have grown by the end of calendar year 2016, which is the highest since 2006. So a lot of good information, I hope, a lot of encouraging news for the region. And before I bring our next speaker to the podium, I want to remind you that we are here for you. The Fox Cities Regional Partnership, whether you're a primary employer or not, our job and our mission is to see you succeed as a business. So if we can ever be of assistance with our data and research capabilities that Shannon mentioned, or if we can help you identify or address a need that you're facing in your companies, please let us know, and we'd be happy to help. So with that, I'd like to introduce a friend, Bruce Zach, the Executive Director and Division Manager of Middle Markets at Chase Commercial Bank in Appleton, who will introduce our next keynote speaker. Thanks for your attention, folks.
Well, good morning, everyone. And on behalf of the Chamber Board and the Chamber staff, I'd like to thank everybody for coming out this morning. It's always great to see, up to 500 people from the community here coming together on a cold February morning. So I've got the opportunity here to introduce a good friend here within the JP Morgan Chase family, Dr. Anthony Chan. He's been to the Appleton market in the past. Some of you have probably heard him speak already. And as recently as yesterday afternoon, he was on the trading floor of the New York Stock Exchange providing a live interview to CNBC. So you may have seen him 2 days in a row now. So he's conducted a very secure and non-disclosed survey or a research study within JP Morgan Chase over the years. So we're going to share that with you, but please don't let it leak outside of the room. It usually helps us get him to the market here. He's traveled around the globe and has done a lot of research on the best sushi restaurants around the globe, and he's determined that Appleton has one of the best on the planet. So when we ask him to come to Appleton, it's usually a pretty easy ask. He says yes pretty quickly. With that, I'm going to just run through a quick bio. Obviously, he has a lengthy list of credentials, so I've tried to shrink this down to something fairly concise. But Dr. Anthony Chan joined JP Morgan in 1994 and currently serves as the chief economist for Chase. Prior to joining JP Morgan Chase, he served as a senior economist at Barclays. Before that, he was an economist at the Federal Reserve Bank of New York, and prior to that, he was an economics professor at the University of Dayton, Ohio. His responsibilities include economic analysis and research in support of Chase and the Private Bank's Global Investment Committee. And in addition, Anthony travels both globally and domestically to meet with clients and make presentations on economics and investments. Anthony has been quoted in many media outlets, including the Wall Street Journal, Barron's, the New York Times, the Washington Post, the Chicago Tribune, the Los Angeles Times, and Investors Daily. Probably after today, the Appleton Post-Crescent as well. So he appears several times per month on CNBC and often is featured in other media outlets such as Fox Business News, CNN, Reuters, and Public Television's Nightly Business Report. As we've all seen here at the start of the year, it's been a fairly restless year in the markets, and the economy is starting to show some some conflicting signals out there, so hopefully we can provide some insight today and give you a feel for what to expect for the rest of 2016 and beyond and how to navigate your business accordingly. So with that, no further ado, I'd like to introduce Dr. Anthony Chan.
Thank you, everyone. It's a little loud, but what I'm going to do today is really give you some good news and some bad news, because there's some good stuff going on and there's some bad stuff going on. It sort of reminds me of two good buddies that loved sports quite a bit. They love baseball so much that they made a pact that if somehow one of them would pass on, they would come back within 24 hours and give the other one good news or bad news as to whether or not there is baseball after life. And so 30 years later, nature took its course, and one of the individuals passed away, but he kept his promise. 24 hours later, he came back, and he said, I have good news and bad news. He said, what's the good news? He said, the good news is there is baseball after life. He says, well, I'm so happy. What could possibly be the bad news? He says, you're pitching next Thursday. But really, what I want to expand on is the excellent presentation that Manny gave about labor market conditions here, because labor market conditions are, in fact, improving in the United States. Here in Appleton, Wisconsin, you now have an unemployment rate of 3.6%, and last year you had an unemployment rate of 4.1%. That's better than the national average of 4.9%. And one of the things that sort of makes me a little bit disappointed is every time you have presidential elections, it doesn't matter whether Democrats or Republicans are on the outside of the White House, you always get this talk that things are really worse than they are. And they're not great, but they're not as bad as what you hear in the presidential campaign. And as I said, this is nonpartisan. Both Democrats and Republicans do this when they want to get into the White House. But the reality is things are getting better. The unemployment rate now is at 4.9%. It was at 10% during the peak of the global financial crisis. And I know what a lot of you are going to be thinking, oh, but that unemployment rate is fake. It doesn't really count. In fact, I heard one presidential candidate just say that if you stop looking for a job and you become discouraged, it treats you as being employed. That's absolutely not true. What happens is that if you really want to count the number of people that are discouraged, there is an unemployment rate for that. That unemployment rate is called the U6 unemployment rate. And by the way, that number is always higher, and today is no exception. That number is 9.9%. And people will say, aha, I got you. That proves that things are really bad. Well, guess what? During the global financial crisis, that number was over 17%. It is now at 9.9%. So even that number is coming down. But if you really just want to remember one number, that is how many people are looking for work relative to the unemployed relative to job openings. During the peak of the global financial crisis, there were 6.8 people unemployed for every job opening. 6.8 people unemployed for every job opening. Today, it's slightly below 1.5 people that are unemployed for every job opening. I don't know how anybody could say that's a bad thing. It's much better than 6.8. If you were unemployed today and looking for a job, it's much better. How about those people that say there's over 90 million people that don't have jobs, and we're not counting them? By the way, that's true. The Wall Street Journal has run articles about this. It's all true. And candidates that are running for president will tell you that, and they're not lying. But you got to put in perspective what that 90 million people are. A good chunk of those individuals are people that have invested well, and now they're retired. Do we want to force grandma and grandpa to go back to work so the unemployment rate numbers look better? No, they're happy. There's a huge chunk of individuals that are going to college to improve their skills, and they're focusing on their education full time, and they're not working. Do we want to take them out of college and make them go to work so the unemployment rate goes lower? Absolutely not. There's another big chunk of individuals that are actually doing okay, I guess, that they have actually dropped out of the labor force to become caretakers, to either see their children grow up, or maybe a family member has gotten sick and they're just not working. And then there's a huge number of people that are disabled. Again, there's a big argument as to whether or not all those disabled workers are really disabled or not, but that's what makes up that 90 million people. So the reality is labor markets are, in fact, getting much, much better. And it is not true that that people are dropping out of the labor force. In the last 6 months, We've seen over 1.5 million people rejoining the labor force. The so-called labor force participation rate, yes, it's low, but it has actually gone up 2 consecutive months now. So labor market conditions are getting better. And that's the reason why consumers spent so much last year. When they say consumers are not buying, consumer spending in 2015 grew by 3.1% in the United States on a year-over-year basis. If that's not a sign that we're optimistic, I don't know what is. Are we buying everything in sight? No, we're not. In fact, we know that during the holidays, retail sales were a little bit weaker. Right after Thanksgiving, my wife dragged me to go, right after Thanksgiving, to go shopping, and I had my hands on a large screen TV, but after being punched in the face 3 times, I let it go. So much you can fight for. But I went into Macy's and bought a winter coat. Nobody competed with me. Weather was warm. But the reality is, look at car sales. Car sales last year were at the fastest pace in 15 years in the United States. If somebody doesn't buy a pair of shoes, a dress, or a sweater, but they go out and plunk down $25,000 or $30,000 for a car, I'm impressed. That's actually more impressive to me than somebody buying a sweater. Of course, we want people to buy sweaters. We want people to go back to the retailers. But again, consumer spending is not so bad. In the fourth quarter, it did slow down to a little over 2%. But for the year, it was over 3%. And I just did a study, which I talked about on CNBC yesterday, that actually finds that when you look at consumer confidence in the United States today, it is a whopping 10 percentage points higher than the average it has stood at just before you enter a recession or as you're entering a recession. 10 points higher. We now have University of Michigan's Consumer Confidence Index at 92, and you basically have seen that number averaging 10 points lower before you go into every recession, on average, the last 10 recessions dating back to 1953. Only one recession that we saw had a consumer confidence number just slightly higher than where it is today. So basically, the consumer confidence numbers are telling us there's only a 10% chance of a recession. Now, what about myself? No, I'm not that optimistic. I actually believe that we have better than a 1 in 4 chance of falling into a recession. I'm putting the probability at somewhere between 25 and 30%. Why? Because the reality is we're not an isolated island. And when you look around the world, which we're going to go into now, you're seeing some turbulence. When I look at China, we're seeing the economy slowing down. Is it collapsing? Absolutely not. We are going to see the Chinese economy this year growing somewhere around 6.5%. How many people in the United States wouldn't cut an arm off so that the U.S. can grow at 6.5%? That's what they're going to do this year. Last year, they grew close to 6.9% on a year-over-year basis. Not bad. But the reality is, why are they slowing down? Because they are now the second largest economy in the world. You can't possibly grow at 12 or 13% like they were growing decades ago because they're just too big. Sort of reminds me of my granddaughter who just turned 11 years old. And she told me the other day, how much did you grow? I grew by 15% last year. And I said, well, I've grown, but in areas I'd rather not discuss. My waist. But so the reality is when you become mature, you just don't grow as quickly anymore. And it's happening to us. It's happened to Europe. It's happening to Japan. It happens all over the world. So 6.5% is still pretty impressive. And the people ask, well, are the Chinese doing anything to try to stimulate their economy? Of course they are. They're doing everything they can. They've lowered interest rates 6 times. They've cut reserve requirements. They've cut the down payments on mortgages to buy houses. They're doing everything they possibly can. They've even resorted to trying to weaken their currency, which is another thing that people are always talking about. Oh, they're manipulating the currency. They've let that currency slide close to 5% over the last 12 to 13 months. Well, guess what? When you look at other countries, look at what's happening with Europe. In the last 2 years, we've seen that currency drop more than 15%. When you look at the Japanese yen, we've seen that currency drop by more than 30%. So if we're going to say one part of the world is manipulating the currency, we could say other parts too. The reality is even we did it. When we did quantitative easing to stimulate our economy, the value of the US dollar plunged. And by the way, it helped our exports. It helped us recover. Everybody does it. And so the reality is they're doing everything they can. So I think that their economy will grow somewhere around 6.5%. We're not going to have to worry that much about it. It's not growing as rapidly as it was, but it is still turbulent. The financial markets are still hurting pretty bad. When you look at Europe, for example, today, what are you seeing? That economy is down a little over 14.5%, about 14.7% on a year-to-date basis. When you're looking at Japan, that economy is down close to more than 15.5%, almost 15.7% year-to-date. When you look at China, that equity market, the Shanghai equity market, is down more than 20% on a year-to-date basis. When you look at the United States, our economy is also down more than 10% on a year-to-date basis. So the big question is it going to influence what happens in the United States? And the answer is yes. Because all of a sudden, when we see all this stuff going on around the world, equity markets going down, it's going to make some of us nervous. It's natural when we see this kind of stuff. So we're going to grow a lot slower this year. I look for economic growth this year to probably be a little bit below 2% in the United States this year. And I don't want to say things are perfect. Look, the other day I heard this news story of a guy that broke into a house because he couldn't find a job. He needed a little bit of money, so he broke in. He ate all the food because he said he was hungry. But then he felt guilty, and he ran the dishwasher, did the clothes. And now my wife is thinking of dating him because, she figures a guy that does all those things. But the reality is, so there is some problems in the United States. And the economy is not going to grow as rapidly. But I think that the probability of a recession is no more than 25 or 30% right now. Because the lower you grow, the higher the probability of something going bad. And by the way, the reality is, this economic expansion is now moving into its 7th year. And if you look at every economic expansion since the 1950s, the average age of an expansion is 4.9 years. So all those things are making me feel like the probability of a recession is increasing. But it's still manageable. Consumers are very confident. 70% of our economy is consumer spending. And if consumers are this confident, I don't feel like things are going to completely collapse. And with regard to central bankers around the world are not just sitting idle. We just saw that the Bank of Japan, just decided to push interest rates even lower. Just when you couldn't push interest rates below 0, they prove you can do it. And they actually have negative interest rates right now. Just this morning, the 10-year government bond yield for the first time in the history of Japan this morning moved into negative territory. So as you push these interest rates really low, it starts making a lot of investment projects a lot more profitable. The European Central Bank has already pushed interest rates into negative territory for bank reserves or bank deposits, not for consumers, but for the banks that deposit with the central bank. And they've said they're going to do a lot more in March. How about the Federal Reserve in the United States? The Federal Reserve in the United States earlier this year, and of course last year, made a projection that they would raise interest rates 4 times this year. Are they going to do that? Absolutely not. They're not going to raise rates 4 times because they've told us that they look at global market conditions. They look at what's happening to our domestic markets, and they look at consumer sentiment. And right now, with things slowing down, they're not going to raise rates that aggressively. Back in September, I was on CNBC just 2 days before the Federal Reserve was going to raise rates, and I was asked, are they going to raise rates? And I said no. And I said, not because I'm smarter than anybody. I'm not. I'm as smart as everybody else in this room. But I just heard the vice chairman say that he's paying attention to global market turbulence. He's also said that he was paying attention to the turbulence in China, the equity market going down. And by the way, now it's down over 20% on a year-to-date basis. And he said because of that, it might be a reason for the Federal Reserve to pause. And he was challenged. He said, you're not the central banker of China. You're the central bank governor or vice chairman of the United States or the Federal Reserve. But he said it's the 2nd largest economy in the world. We can't ignore it. And guess what? Those things are happening all over again. We're seeing global market turbulence in Europe. We're seeing the equity market weaker there. We're seeing it in Japan. We're seeing it in China. Of course the Federal Reserve is going to pause. And so when Janet Yellen speaks and does her semi-annual testimony on Wednesday, she does it, and then does a repeat performance on Thursday, I have no doubt that she's going to pull back those 4 interest rate hikes. And the reality is, if they do that, that's going to help us avoid a recession. And when Mario Draghi meets in March, there's no doubt he's told us they're going to do a lot more. So with central banks doing a lot more, that's why I believe that the probability of no recession is somewhere in the neighborhood of about 75%. I think it's 70 to 75% chance that we'll be able to get over this. We've had scares in the past, and a lot of times when we have a scare, people think, oh, that automatically means a recession. We had the October 1987 equity market crash. We didn't have a recession. We had long-term management capital crash, a big hedge fund crashing. We didn't have a recession. We had the Mexico crisis. We didn't have a recession. We can get through crises as long as our government officials and as long as we have other things going for us that are good. And one of the things that were going for us is that I think the central bank would react positively. And I also think that consumers are still very positive. Today we have household wealth in the United States that's almost at the highest level it's ever been in the history of the United States. During the global financial crisis, we went through some rough times. We lost almost $13 trillion worth of wealth. That's a lot of wealth, even if they tell you $1 trillion doesn't go as far as they used to. That's still a lot of money. But we got it all back, and we got another 13 on top of that. So we are now at one of the best positions in terms of wealth these days. And so with that as a backdrop, I really feel that we have a lot of turbulence out there, but I really believe that we have a chance to get over this. And in terms of the equity market this year, yes, there's a lot of turbulence out there and people are worried. Why are they worried? They're worried because oil prices are low. I recently did a study that actually looked at what happens to oil prices when they're going down, and why is it that equity markets today are so worried about low oil prices? Because the last time I checked, last year, the United States is still an oil importer. We paid out to countries, sometimes even countries that don't like us, $82 billion worth of oil import costs. That's how much we pay to other countries to import oil. Because even though we've doubled the production of oil in this country from 2008 to where we are today, we still import oil. We paid $82 billion to import oil this last year, in 2015. The year before that, we paid out $174 billion. Please help me understand why people think that if we pay out to other countries and money doesn't stay here, 82 billion instead of 174 billion, that we're better off when we pay out 174 billion. Couldn't we use that extra 80 or 90 billion dollars to improve our schools, or maybe to use it to purchase other products, or to increase our standard of living, rather than say we'd rather spend 80 or 90 billion more to import oil? Of course not. So I think that low oil prices are actually not such a bad thing. Are they bad for some parts of the United States? Of course they are. We don't want to see Texas, even if people don't like Texas, suffering. They're part of us. They're part of the family. We want Texas to do well. We want the Dakotas to do well. We want the United States to do well. But the reality is we're still net oil importers, and oil prices are good. But I did a study, and I found that when oil prices are somewhere in the neighborhood of $20 to $50 a barrel, that stock prices move in the same direction as oil. And you might say, why? Because we get the impression that when oil prices are very, very low, that automatically means that things must be very bad. And when they go up, that must mean that things are getting a little bit better. But the reality is when oil prices went down this time, they didn't go down because demand was actually dropping. Because the reality is last year, the demand for oil in this country was up 2% on a year-over-year basis, 2%. You might say, what's the big deal? That's the fastest pace since 2011, fastest pace in 4 years. Does that sound like we had a demand problem if demand was at the fastest pace in 4 years? No. How about if we doubled our U.S. production from 2008 to 2015, doubled the production? That shows me that we are, in fact, having a supply problem. At the peak last year, we were producing as much as 9.7 million barrels of oil per day. The latest number is 9.2 million barrels of oil per day. So we're still producing a lot. We have now cut back our oil rigs by almost 74%. But you might say, why aren't we cutting less? Why aren't we producing less oil? Because you don't have to be a Texan to figure out 30% of our oil rigs produce 70% of our oil. So we're working our existing oil rigs, even though we shut down 74% of them, a little harder. And that's why we're producing so much. And OPEC is still producing quite a bit. OPEC is producing a couple million barrels above their quota of 30 million barrels of oil. Russia is producing oil like it's going out of business. Again, at one of the highest levels that they've been producing in years. And when you look around the world, you now have Iran that's coming back into the picture. They had reduced their production of oil. We had the sanctions, and now they're increasing the production of oil. They say they're going to increase by 1 million. Most people think it's going to be about 500,000, but that's an extra 500,000 barrels of oil on top of the fact that overproduction last year was in the neighborhood of almost 2 million barrels of oil per day. So when you have overproduction of almost 2 million barrels of oil per day, You can see we're awash in oil. In fact, when I sat down underneath my coffee plate, I checked to see if there was oil there. Because we have so much oil, I figured there might be some under the coffee cup. So that's the reason why we're seeing this. And by the way, for every penny of gasoline per gallon that it goes down, it puts $1 billion into the pocketbooks of U.S. households. How could that be a bad thing? Net, it's a positive thing. But that's the way financial markets operate. When oil is at low prices, equity markets react negatively. But my study also found that when oil prices are above $100 a barrel, then it becomes normal again. Now, when oil prices go up, the stock market goes down because you get the impression that it's going to snuff out economic activity. So the reality is that when you have low oil prices, it reacts this way, and then when you have higher oil prices, it reacts a different way, which is, I think, more normal. High oil prices are actually not positive. But so this year, I'm looking for the equity market to pick up from here. It's down significantly, but I think that from here, we can see a recovery anywhere in the neighborhood of 5 to as much as 6% from here. It's not great because it's still going to be a slightly down year, but it's going to be an improvement from here. And the reality is that when people invest in the equity market, you got to have a longer-term perspective. I would say a minimum of 5 years. Why do I say that? We did a study at JP Morgan that found that if you look at over the last 40 years, 5-year investment horizons, we can never find a period where you would have lost money in the U.S. equity market if you would have had a 5-year investment horizon. In fact, it reminds me of a wise man. I think his name is Justin Bieber. Justin Bieber said the other day that just because you walk into a Taco Bell and eat a taco doesn't mean you're a taco. Now, I know it's Justin Bieber, so you've got to work with him. What he's saying is just because you invest in the stock market doesn't mean you're an investor, unless you have that long-term investment horizon. Because people are thinking, oh, last year the equity market barely went up if you include the dividends, but the index actually slipped. But after you include dividends, you had a slight positive rate of return. So it's not great because we want the equity market to go up year after year. But the reality is you can't look at the market year after year. You got to look at it over a long period of time, over a multi-year investment horizon, 3 to 5 years. That's when you get the positive rates of return. If you're looking at the equity market on a day-to-day basis, month-to-month basis, that's when I think you get into trouble. And that's when you're going to be disappointed. So the equity market over the next 5 years will give you a positive rate of return. Will we have corrections? Absolutely. If you would have gone back to when I started my career in 1940, you know, if you're not laughing, that's bad. I didn't start my career in 1940. But I've looked at the equity market since 1940, and you've had 25 market corrections since 1940. Market correction is down more than 10%, but less than 20%. 25 of them. But if I would have told everybody in this room in 1940, would you want to invest in the stock market if you're going to experience 25 market correction? Most of you would have said no. But the reality is if you did, you would have gotten an average rate of return, even after adjusting for those market corrections, of over 6%. And then you add dividends to that. Dividends today are around 2%. Not a bad investment experience. But again, is it turbulent? Yes. Do you have to take antacids and do you have to use motion sickness pills? Of course you do. But that's why it pays you more than a bank CD rate, because you're taking that risk. And that's the kind of perspective you got to have. You got to have that long-term investment horizon when you're investing. So again, I want to wrap up because I know I'm running out of time. The wrap up is the U.S. economy this year will probably grow barely close to 2%. We're going to continue to see labor market conditions improve. We do have an opportunity or a risk that we slip and that forecast of almost 2% slips and we move into a recession. But I put that probability at no more than 25 or 30%. 70% chance things will go well, the base case scenario will work out, we'll get about 2% growth. We are in a good position, and by the way, if we go into a recession, the big question is it going to be a major recession or is it going to be a minor recession? Well, given the fact that you're looking at the U.S. economy today, I say that the fundamentals here, with the exception of some sectors like the energy sectors and the materials sectors, and even the manufacturing sector is struggling. The manufacturing sector is struggling a little bit. But why is it struggling? It's struggling because of the stronger dollar. It's struggling because of slower global economic growth. To the extent that the dollar stabilizes a little bit and stops getting so strong, that will help the manufacturing sector. And by the way, the manufacturing sector today is really powerful. When I was growing up, I remember the manufacturing sector was hiring, had almost 30% of the labor force. I remember telling kids in my neighborhood, is this really sustainable? Well, that's why I didn't have any friends growing up. Today, the manufacturing sector hires 8.6% of our population. But guess what? Our production is more efficient than ever. We have a U.S. manufacturing sector that's second to none. Everybody in this room that's associated with the manufacturing sector should be proud, because we have a manufacturing sector that I had no idea we could have when I was growing up. It is efficient, it is powerful, and we are producing more manufacturing output today with only 8.6% of the U.S. labor force than we did before. And does the manufacturing, I know I was going to wrap up, but I had to mention one more study I just finished. I looked at a study because so many people tell me that the manufacturing sector, because it's weak, it tells you a recession is coming. And so I looked at the ISM manufacturing survey, and I found that whenever that survey is below 50, which suggests contraction, that gives you about a 56% chance of either being in a recession or being in a recession in the next 12 months. But today, because the economy is mostly services, more than 90% of the economy is services, I also looked at the ISM services services index, and that index says that there's about a 72% chance that if that index is below 50, that we go into a recession. And guess what? That index is not below 50. It's actually in positive territory at over 50, 53.2. That's what gives me the hope that we're going to be able to get through this. And if we get that dollar to get a little bit weaker, it'll re-energize the manufacturing sector, re-energize the U.S. economy, and 2016 will not be a bad year after all. Thank you so much for having me.
We are opening the floor up for questions. We have an expert here in-house, so feel free to raise your hand. And I believe we have some microphones in the back of the room, so speak up, and Dr. Chen will give you his best shot.
Let's do the questions. Yes. That's great, because when you look at the U.S. banks today, thanks to a lot of the regulation that some of us in the banking industry think is too much, some that are not in the banking industry say it's too little, whether you like the regulations or not, it has made the banks a lot stronger. Capital today is at one of the highest levels that we've ever seen in the banking sector during my lifetime. So I think that there's no doubt in my mind that the banking sector is much stronger to withstand the amount of stress that can occur if the economy moves into slower growth mode or even a recession. With regard to Europe, last year, full disclosure, I forecasted that for 2015, Europe would grow by 1%. I was dead wrong. Europe, we don't have the final numbers yet, but Europe will probably end up growing about 1.2%. So I was way too pessimistic. I'm going to try to be pessimistic again this year and say that Europe would probably grow 1.1%. But already people are trying to beat me up and telling me I'm being too pessimistic, that Europe has the potential to grow a lot faster. Why do I think Europe will grow only 1.1% this year? They're facing an immigration crisis. That can slow things down a little bit. We just saw some numbers overnight from Germany that industrial output or industrial production slipped by 1.2%. But yet, we're still seeing a lot of resilience in many of the countries. Spain this year will probably grow in excess of 3%. France is having some trouble. Obviously, the terrorist attack hurt it. But we're seeing Italy with the banks of the financial sector having some trouble. But even then, we are seeing a lot of excitement in many other countries in Europe, and we're seeing the central bank very enthusiastic. So I don't think Europe will actually have a recession. I think Europe will pull through and grow at around 1.1%. So the big differences between 2008 and now, we had a bubble out there. We had a housing bubble today, and today housing prices have come up. Everybody knows that. Nationally, some parts of the country less than others. But guess what? Case-Shiller is telling us that prices are just barely almost to the level as to where they were in 2008. And that's what? 7 years later. And we've seen all this wealth increasing and housing prices are just now catching up nationally on average to where they were in 2008. That doesn't seem to me, or 2006, that doesn't sound to me like we have a bubble in the housing market. And even in the stock market, we've seen price-earnings ratios come down quite dramatically. We now have price-earnings ratios that are basically slightly lower than the averages that we've seen over the last 15 years. So I'm just not seeing a lot of bubbles out there that would make me feel that something on the order of 2008 is likely to materialize. Other questions? Yes. The youth? Great question. The question is, what happens to our markets right after the elections, or even this year during the elections? And by the way, I did another study that actually looked at the 8-year presidential cycle. And I hate to give bad news here, but I'm going to give you bad news. The year of a presidential election year, doesn't matter whether they're Democrats or Republicans, is actually pretty good if the person in the White House can run for re-election. But when the person in the White House, Democrat or Republican, cannot run for re-election, it happens to be the worst year of the presidential election cycle, and I count that cycle as an 8-year cycle. The average decline in the S&P 500 was 3.2% decline, minus 3.2%, the worst. The good news is the next year, and I go back to the 1930s with this study, the average increase is 8.9%. So that gives me a little hope that things are going to be a little bit better. So then the next question a lot of people will ask, which I'm sure is what is implied in your question, is when does the equity market do better? When you have Democrats or Republicans? I'm the most nonpartisan economist you'll ever hear, so I take no sides. But I'm going to try to answer that question in a nonpartisan way. If you're a Republican, I did a study 20 years ago. I've been in the business now 32 years, so I've been in the business a long time. I did a study 20 years ago, and I found that the equity market does a lot better when the Republicans are in the White House. So the Republicans in the room must be very excited with my study 20 years ago. But I recently updated that study, and it included more presidents. And because the equity market has done so well did so well under Bill Clinton and did so well under Barack Obama, now the equity market ends up doing a little bit better when you have Democrats in the White House. So if you're a Republican, use my study from 20 years ago. If you're a Democrat, use my recent study. But then the final study that I did was, when if you go to the voting polls and you vote for a Democrat or Republican, make sure you vote the opposite party for Congress, because that's when the equity market does a lot better. So vote who you like for president, but do the opposite for Congress. And if you win and your dream comes true, then the equity market has a better experience. So I expect next year to be a little bit better than this year. But this year will be a rough year for the equity market if the last 50 or 60 years are any indication of what happens during the 8th year of a presidential cycle. Other questions?
I think we've got one here in the back.
Testing, okay. I have a son who's an equity researcher in Chicago, and he couldn't be here today, but he has a question, and it's corporate tax laws, and on a related note to the last question, corporate tax laws are becoming a prominent issue in the upcoming election. How do you think a significant increase in corporate taxes would affect the way multinational corporations that are headquartered domestically interact in the global marketplace?
Okay, if everyone heard that question, is basically the question, to rephrase it, is what are the implications for the U.S. corporations if we raise corporate taxes? I think everybody in this room knows that if you raise corporate taxes, it'll make our multinational corporations and even our domestic corporations, make it a little bit more challenging for them to compete. So obviously, even as a nonpartisan economist, I would not be in favor of raising corporate taxes. But the big question is, the real follow-up question should be, are U.S. corporations too highly taxed today? And the answer is not really, because a recent study was done, I think it was done by Warren Buffett, probably by some of his people, and not that I'm partial to Warren Buffett or not, but I found the study fascinating. They looked at U.S. corporate tax collections as a percentage of the overall economy. And today is at one of the lowest levels since the 1930s. So that tells me that U.S. corporations are not too highly taxed. So if that's the conclusion, why am I not in favor of raising the tax a little bit more? After all, we have over an $18 trillion deficit. Because it's not whether they're too high or too low relative to history. It's whether or not they're too high or too low relative to our global competitors. And our global competitors around the country around the world rather, have lowered corporate tax rates to the point where today our US corporations, many instances, want to move out of the United States domicile so they can have lower corporate taxes. So I think as long as we have this competition, we have to be very, very, very careful to make sure that our US corporates are having a competitive environment rather than an environment where they're put at a disadvantage. And to prove to you that I'm nonpartisan, I would tell you two little stories on both sides. On the Democratic side, Bernie Sanders, I heard the other day a true story that he was giving a campaign speech and somebody in the audience fainted. And he went up there and he started yelling at him, says, "You can't die, get up, get up. The middle class needs to be saved." So the guy came back, he was fine. He had a broken eardrum, but other than that, he's fine. On the Republican side, you all heard Donald Trump recently had a bad experience. He was on a plane, he had an emergency landing in Tennessee. Everybody got scared. We were all glad that he's safe and nothing happened. But Donald Trump came out winning, as he always does. He said he made the airplane manufacturer not only build him another plane, but also pay for it. So, you know, he's fine. He's fine. All right. Enough with the bad jokes. Okay. Other questions? After that bad joke, nobody wants to ask a question. All right, yeah. Oh, that's a great question. How long before we go back to a normal interest rate environment? A study was done, not by me, but by the Federal Reserve, that actually found that in this new environment where we now have had this global stagnation, or some people call it secular stagnation, where we are growing a lot slower than we ever did before. The normal interest rate that many of you were accustomed to when we were growing up, and many of you are about my age, it's going to take longer and longer and longer. For many years, people thought a 3 to 4% Fed funds rate was normal. Today, in this new environment where every single country around the world is growing a lot less, it's very, very challenging. So I would not be shocked if we could be looking at a period of 5 to 10 years before we actually can say the US economy can actually withstand interest rates that were normal when many of us in this room were growing up, because we are now simply in a different environment. Of course, to say that kind of makes it like I'm cheating and not telling you why this situation is the way it is. A study done by the University of Maryland, Ken Rogoff and Carmen Reinhardt, Ken Rogoff from Harvard University and Carmen Reinhardt from the University of Maryland, when the study was done, found that whenever you have massive debt from the government, it slows our ability to grow. And when we slow our ability to grow, it means that we can't move to normal interest rates. Because the study found that whenever the debt to GDP ratio is above 90%, that it slows our growth numbers. That is precisely why today, no matter which politician, Democrat or Republican, keep promising you that they're going to grow the economy at 4 or 5%, they're not telling you the truth. Why not? Because it's not physically possible in this environment. We are suffering from the handicap of this high debt. And by the way, the high debt was caused by both Democrats and Republicans. This is not a partisan statement whatsoever. But as long as we have this high debt of 103% of GDP, way over 90%, we can't grow so rapidly. So think of the US economy as operating with a big ankle weights. We just can't grow as rapidly. And if we can't grow as rapidly, it's very challenging to have normal interest rates the way we were accustomed to 10, 20, 30 years ago. Interest rates will be much, much lower in this environment. They're so low that many countries are resorting to negative interest rates. How much more unnormal than that can you get? It's very hard to get more unnormal than that with negative interest rates. Do we have time for another one, or how are we doing? One last question, if anybody wants to take it.
Several of the references that have been made today are regarding weathering the storm, so I'm going to try to continue that analogy. A lot of the small businesses in the Fox Cities region are sort of navigating those storms in, let's say, rowboats, bailing feverishly or hanging on, and so not worried so much about how to navigate through the storm and which direction they're headed, but just how to stay sort of engaged. And what would be your advice as far as what to message to them?
That's a great question. Probably the best question of the whole night, whole morning. And that is, what is the best advice I can give to a small and medium-sized business today here in the region, but really all over the United States? First of all, as a given, we should acknowledge that close to 80% of all the jobs in this country are created by small and medium-sized businesses. So my hat's off to small and medium-sized businesses. You are the heartbeat of America. But the big question is, what should you do to try to prepare yourself for the future? And the answer is pretty simple. Today, we have an environment where there's no price pressures. So increasing your prices in order to get a higher profit is a non-starter. You're not going to be able to do it because you have so much competition out there and inflation is so low that you're not going to be able to make that price stick. And if you do increase the price anyway, chances are your customers will go to some other competitor to be able to get a similar product at a much lower price. So what is the way to win? The way to win is to focus your energies on trying to improve your productivity and your efficiency and trying to make sure that you completely convince your customer that you have a better service. You not only have a better mousetrap, but you offer better customer service, a better customer experience. Last year, productivity in the United States grew by 0.3%. That's terrible. And in fact, in the fourth quarter, it contracted on a quarter-over-quarter basis by almost 3%. That is the reason why we are struggling. And by the way, that's the reason why this year, even though last year we had one of the best employment years, this year I'm forecasting that employment will grow, but it won't grow as fast as last year because companies don't have as much incentive to keep adding bodies if productivity is so low. So bottom line, if you're running a business, focus on trying to make that customer experience better, but don't focus on trying to raise your price to get a higher profit. Focus on trying to use technology to improve your productivity so you can actually provide the same product to your customers at a cheaper price. That's the secret to making more money in this low inflation environment. The secret is no longer, when I was growing up, oh, let's see if we can pass an increase onto customers. That's not the secret anymore. It doesn't work. Let's see how much I can make my product better and more efficient and produce it at a cheaper price with the same quality, using more technology if necessary in order to succeed. That's the winning formula for small and medium-sized businesses. Thank you so much.
Now you know why I wanted to get off the stage so quickly to hear Dr. Chan's perspective. Thanks again to our great speaker, and thank you to our sponsors one more time, Chase, Wipfli, Coldwell Banker, and Fox Communities Credit Union. Thanks for your help putting this event together. Thanks also to the Fox Cities Regional Partnerships investors. You can see their logos in the back of your booklets. We couldn't do our work without their support. So you heard a lot about politics and government during Dr. Chan's presentation. I want to remind you that the Chamber is hosting their annual Legislative Dialogue Breakfast next Monday, February 15th. You see some reminders on your tables from 7 to 9 a.m. at the Bridgewood Hotel in Neenah. I also just thought I would remind you of that. Thanks again for joining us today at this annual event, and that concludes our program, and let's make 2016 a great year. Thank you.